This is Steve Colano, and this is Confidential Remarks. We've seen this pattern repeat throughout history. A corporate giant with endless capital and total market dominance suddenly collapsing under its own weight. These behemoths are rarely toppled by other giants. They are destroyed by tiny, underfunded startups. Business strategists identify the environment where these giants operate as a red ocean. It is a zero-sum economic condition where multiple companies fight for a share of a fixed, often shrinking pool of customers. Within a red ocean, the rules of engagement are rigid. Success requires a constant cycle of aggressive price cutting and minor incremental product tweaks just to maintain a baseline of relevance. This diagram represents the mathematical outcome of that hyper-competition. As the market reaches saturation, it begins fragmenting into microscopic slivers. Products become indistinguishable from one another, and razor-thin profit margins eventually stall all growth. The early 2000s razor market followed this exact trajectory. Gillette maintained its dominance through a high-margin feature war, adding blade after blade to a design that was already functional, while squeezing the rest of the industry to the absolute edges of the chart. This raises a difficult question. If fighting a giant on their own turf is economic suicide, how do disruptors actually manage to topple them? Disruptors don't win by playing the established game more effectively. They win by bypassing the battlefield altogether. This is the blue ocean strategy, the deliberate move away from crowded markets to create an entirely new, uncontested space. A blue ocean strategy makes the competition irrelevant to the consumer by offering a level of utility that established players simply don't provide. The engine behind this shift is a process called value innovation. Value innovation works on a dual mandate, making operational costs drop while driving buyer value upward. Netflix utilized this model to bypass Blockbuster, lowering costs by eliminating the massive physical overhead of retail stores, employees, and inventory. While costs dropped, they increased value by addressing unarticulated frustrations of customers, the late fees and store travel, replacing them with friction-free home delivery. To achieve this, a company has to abandon industry norms. They must identify the deep consumer pains that legacy giants have become blind to. We can see this same logic in the hospitality industry, where value innovation relies on an offer that ignores traditional capital requirements. Historically, the hotel industry was defined by its barriers to entry, the massive capital expenditures needed to buy land and build physical structures. Airbnb bypassed this entire cost structure. As this map shows, the centralized hub of a hotel vanishes, replaced by existing decentralized residential infrastructure that Airbnb didn't have to build or buy. Because they weren't paying for new buildings, they could offer travelers a new kind of value, affordable, authentic, local experiences that standardized hotels cannot replicate. Creating value is the first step, but scaling it requires bypassing the traditional gatekeepers of retail. Dollar Shave Club achieved this by ignoring the shelf space Gillette dominated. They use viral marketing and a subscription model to connect directly with millions of consumers, managing the entire relationship through digital systems. An irresistible offer works by removing the friction found in legacy industries and delivering that solution through a direct-to-consumer distribution model. Scaling these operations globally requires a one-to-many framework, allowing a company to reach a massive audience while maintaining a direct connection. While traditional selling relies on inefficient one-to-one interactions, the one-to-many approach uses digital leverage and automated CRM systems to maintain continuous engagement with millions of people at once. Operating in a blue ocean changes the focus of growth. Companies no longer fight for a share of existing demand. They dictate the market's trajectory. By solving unarticulated needs, these companies expand the market pie. They create entirely new demand from people who were previously non-consumers, as shown by this expanding boundary. When the gap between the value provided and the friction of the status quo becomes wide enough, it leads to a specific psychological state, the moral obligation to buy. This isn't about guilt. It describes a product so frictionless and beneficial that the customer perceives a reciprocal, logical duty to choose it. They buy because the exchange of value has become too high to ignore. Exponential growth demands more than just a better product. It requires the vision to abandon the war of attrition and invent a new game where you are the only. This has been Confidential Remarks.